This conference will now be recorded.
Okay, so good morning everyone, and welcome back to a fresh new session on credit risk modeling. And in the last class, we had started our discussion about uh, So we had started our discussion of the last two sessions on scorecards. And in terms of scorecards, what we had been discussing is we started discussing about the segments of the acquisition models, and we had started discussing about the segments of the behavior models. And then from there, we had seen what are the different kinds of segmentation, what are the different characteristics of doing these segmentations. And then in the last discussion we had also started about understanding how acquisition scorecards are used, right? So basically, what we are doing over here is we are just first trying to understand, before developing a scorecard, what we are trying to understand is that what is a scorecard, how exactly is a scorecard kind of being defined, right? And how exactly and where exactly is it being used, right? So that's the part that we are discussing before we enter into talking about how to model the score. Before we model it, we are first trying to understand how exactly is it being modeled, and uh, like what is it that we are trying to model. Okay. uh, Guys, just give me a second. Okay, so as I was saying, right? Uh, so we had started seeing how acquisition scorecards are used, right, in terms of taking decisions and so on. So before we start developing the models, right, what we are trying to understand is that how what are acquisition scorecards. So we had already had a discussion in the initial sessions. So what we are trying to do is we are trying to kind of do a deep dive into it. We are trying to understand the key kind of factors that would drive an acquisition scorecard model. How would an acquisition scorecard model look like, how to assess the performance of the model, and how to use it for business strategy. So that's the first set of discussion that we are trying to have over here in this, right? Once we understand this portion, once we have an overview of the working of scorecards and its applications for both acquisition and behavior, then we'll take up building them step by step, right? So that's the idea of the discussion, right? Okay. So talking about, so we had begun our discussion about acquisition models, and when we are building an acquisition model, or when we are designing a set of when the acquisition set of strategies are being designed, right? So one thing that we had seen is that for acquisition strategies, there are three broad kind of exercises that happen at an acquisition stage. First, an accept decline decision is taken. The second case is you decide on the limit assignment, and the third is you decide on the pricing. So these are the three areas on which you generally need to discuss, right? Or these are the three areas on which we define the acquisition strategies, right? So first of all, let us try to understand how the acquisition scorecard would look like. What is the population flow, right? And from there, what we are going to do is we are going to understand how how is it that a model is assessed, So once a model is built, how is it assessed? And finally, what we are going to talk about is that what are the key kind of factors that drive acquisition models. And uh, finally we'll talk about the acquisition strategies and how even what framework is used to build the acquisition strategies, right? So that's the portion that we are going to that's the that's the flow of the discussion that we are going to use, right? Now if I think about an acquisition model, right? uh, so what you are trying to do through an acquisition model is you are trying to build a framework which will help you, in acquisition models. So what we are trying to do in an acquisition model is we are trying to. Okay, so when an acquisition model is being built, or when we're trying to design an acquisition model, we are trying to capture the borrower's origination risk, right? At origination we are trying to assess how a borrower is, or how would a borrower behave if he is actually given the loan, right? So what are his elements of riskiness? So that's where you have your origination model. So basically what I'm trying to do is I'm trying to capture my origination risks, right? So while I talk about my origination risk, so there are a few important things that we need to take care of, we need to talk about. So when you are building, so we know that when we are building a model, or when we are building a strategy, what we need to do is we need to build it on a representative population, right? Because if my population is not representative, then the model that I am building will become a biased model. So over here, the acquisition model or any acquisition strategy, it should be built on the through the door model, or the through the door population. So when I say through the door population, so the through the door or the TDD population implies. So through the door population would imply that all the set of applications that would come into the books of the, so would come to apply to the books, to the bank, right? So this is the population who, or the entire base of applicants who had historically applied to the bank. Entire applicant base, entire historical applicant base, right? So this refers to the total base of the accounts who are applying for the product. Now from here, on this historical applicant base, there are two things that can happen, or that could have historically happened, or rather three things that could have happened. First is, the account could have, or the applicant could have been booked on the books of the banks, or he could have been a booked applicant. The second part over here is, he could have been a rejected applicant, could have been a rejected applicant, and the third applicant is that could have been is cancelled applicant, or it could have been a cancelled application, because if it's an incomplete application. Now, based on the total number of completed applications, so this is a part of incomplete or complete applications. So applications which has been appropriately completed, right, with all due KYCs and stuff. So all the this will be the base of the completed applications, right? So incomplete applications are cancelled applications, right? So this is how the base of your model looks like. So basically, when you are building an acquisition model, what you are expected to do is the modeling base of the account should include or should be replicative of or representative of the through the door population, right? So over here, your modeling data will comprise of or should simulate. Now, with the cancelled applications, you cannot do anything; they have to be excluded. So these cancelled applications, they are a part of exclusions or data exclusions when you are building the model. So you exclude this data. Now this modeling data has to be representative of the through the door population. Hence, this will include all accepted or booked accounts plus rejected base. Right. Now within the accepted base, you can also have a further set of exclusions. Right. So what are those exclusions? So the exclusions that you have over here is you can have accepted base, and within this accepted base you can divide it into two parts. One is booked accounts, and the other is non-booked accounts. Will be non-booked accounts. So basically, if an even if an application is accepted, it is not necessarily that if I apply and I'm accepted, it may be that I am not willing to take a loan from this bank because of some specific exercise, right? So only the accepted and booked accounts are the ones that should be used for model development or developing an application scorecard, right? So this is something that we are going to look at. Now over here, while we look at it, so I have the accepted and I have the rejected base, I have the booked and the non-booked base and so on. So this will be my accepted base and this will be my rejected base. Now, while developing acquisition models, there is a very typical problem. And what is that? The problem is that for the accepted base, you have the bad flag, or you know who are the accounts who have already kind of defaulted and who are the ones who have not defaulted, right? For the accepted base, the observed target variable is there, the observed default flag exists, right? So you know the y equals to 1, y equal to zeros because they have been given the loan, they have performed on the loan and then they have either defaulted or they have not yet defaulted on the loan, so they are current and on the books of the banks. So accepted base has this. However, the accounts who were rejected, right, do not have the missing flag. I mean, do not have the default flag. So for them, the default flag is missing. Now, if I am to append the records in a data, so if I am to append the records in a data, what would ideally happen? So you have accepted plus rejected, right? So observe. So over here we have the observed default flags. Then we have the default flag missing, and over here you have the observe. So basically over here you have the existing data, and you would create your base of accounts using accepted plus the rejected base. But for the default flag, the but for the rejected base, the default flag is missing because these accounts were never given a loan. Because they were never given a loan, they because they, I mean they were always rejected by the bank, so they're rejected by the bank, therefore you do not have the default flag for these rejected bases. So when I am appending the data and I'm creating this total base of accounts, then the target variable column will be missing or empty for the rejected accounts, and hence developing the model like that would not be possible. Therefore, the first step that we need to follow or that we would need to do over here is to create a or infer a possible default flag for the rejected accounts, and that is where the reject inferencing comes in. The reject inferencing. So this is where reject inferencing comes into play, right? So over here we have two set of accounts. One is the accepted base and the rejected base, and then what we have over here is the default. So basically our first objective is to build a reject the reject, to do the reject inferencing and create an inferred bad flag. So the outcome of the reject inferencing exercise is the inferred bad flag for this base of accounts. Now once you have the inferred bad flag, then you can go about developing the model. Inferred bad flag. So the objective of the reject inferencing is to create an inferred bad flag for the rejected base of accounts. So there are two sets of two base of data that we have, right? So the first set of base of data that we have here is the based on the accepted base. So this base is known as the KGB base or the known good bad base. The known good bad base, or as we call it, the KGB base. Now, developing the model only on the KGB base would make the model unbiased, or would make the model biased, because the only so then the model will have the ability to only capture or assess the profiles of the good borrower. So if he gets some bad profiles, his the predictions performed uh, by this model will be very random. In order to avoid this, what we are trying to do is we are saying that it is the known good bad. So what we are trying to do is we are trying to use the known good bad base, right? So this is something that we are trying to achieve over here. Right? So I have a known good bad base, I have the KGB base, and what we are trying to do over here is we are trying to, so this known good bad base is the base of accounts where, so which is used for reject inferencing. So first a model is developed on the accepted base, on the known good bad base, and then that model is executed on the rejected base to get the probability of default for the rejected borrowers. Now how reject inferencing is done is a detailed exercise, right? Now this known good bad base is used or applied for reject inferencing, used for RI, used for RI scoring, reject inferencing scoring. Now, this is a very important exercise from the perspective that the more accurate your prediction of the rejected base and its flag would be, right? Its observed flag would be, the better would be your model, right? So where you have the good, the known good bad base, and the model developed on the known good bad base for reject inferencing is really important, right? Now, the next step that comes over here is, so once we have built the model, then and we have done the reject inferencing. So from here we get the KGB base has observed good bad flags, has observed target variable, or has observed default flags, plus the rejected base after RI, or I'll say the reject inferred base. So the reject base with the inferred bad flag. Inferred base, rejected flag, or you have the inferred default flags over here. Inferred default flags, right? So you have inferred default flags over here. So over here, so if I add these two base, I will get my representative through the cycle base, which is known as, or which we call as, the inferred good bad base, or the augmented good bad base. Augmented good bad base, or as we call it, the AB base. Now this is also known as the known inferred good bad base, or the KIGB base. So you can call it either ways, right? Now it is on this AGB, or the overall popular, the augmented good bad base, the origin or the actual scorecard is developed. So on this base, the origination scorecard is developed. The origination scorecard is built. scorecard is built. Now, when the origination scorecard is being built over here, there are some important factors that we need to look at. Okay, so on one hand, you have the originations. You have on one side we have the origination scorecard, right? So when I'm talking about building this origination scorecard, the objective of this is to generate the origination score, right? Now over here there are two questions that we need to answer. So one of them is, what are the variables that are, what kind of variables go into building an AGB model? What variables? Right. The second question that comes out over here is that what are the steps of variable reduction for building the model? So when I'm trying to build the model, what are the steps of the variable reduction? Now these are the two questions that we will start talking about, or these are the two questions which we will discuss. Right? So over here there are a few criteria that we need to talk about. First of all, what I'll talk about is that what are the what are the key type of variables, and what are the steps of variable reduction. The set of variable reduction is uh, it is more or less standardized across models. So what we'll do is we'll create a checklist of these measures, right? So but before that, before we try to talk about it, so there are some important factors which needs to be discussed over here before we go into the steps of the variable reduction. So what we'll start off with is that what are the key kind of variables that an acquisition scorecard would use, and we'll be talking about this in terms of the credit card products, right? So what are the key kind of what important variables that should be entering into this acquisition scorecard? Now we know that at an acquisition or at an origination level, it is the external information which actually, you know, overtakes or is of a greater importance as compared to the bank's internal information, right? Okay, so before I start off with this portion, I'll just take a pause. I like to know if there are any questions that you would have.
And
Uh,
can you explain this reject inferencing thing again?
Sure, I'll do it at a high level. Yes, Suji, tell me.
yeah, my question was also the same, that how do we do the rejection inference?
I'll come to that.
Okay.
I'll come to reject inferencing. So at this level, let us try to understand that reject inferencing is done by developing the model on the known good bad base, and then executing this model or running this model on the rejected base, right? So you will get the probability of default for each of the accounts at the rejected base, and once you have that information, then what you do is you create a cutoff on that probability of default, and then you create your inferred 1 0 flags, right? So it is done simply by running the model on the developing the model on the KGB base and running it on the rejected base to create the inferred flags. Now there are different kind of nitty-gritties to reject inferencing. I'll come to that nitty-gritties a little later because that will take me to the model development mechanism, right? But before that, let us just try to understand the key sources of risk that are there, right? And then then I'll come to and the set of variable filtration which is used, and then I'll come to talk about the results of reject inferencing and how reject inferencing is exactly done. Because to develop reject inferencing models, there are different kind of approaches, like the overall accepts approach, there is the marginal accepts approach, right? So then you have the like removing the top 20% of the observations, and or the below 20% of the observation, and trying to assess the performance of the representative class and so on. So there are multiple analyses that can be done to assess the effectiveness of a reject inferencing exercise and check which is the one relevant to your respective portfolio, right? So there are different ways to do it. So I'll come to reject inferencing a little later, because when I show you that there, so more specifically I'll be talking about RI in tomorrow's session, right? So I'll be discussing reject inferencing, how reject inferencing is done, and what are the mechanics around it, and so on. So we'll discuss that along with the data set in tomorrow's session, right? But over here what we are trying to do is we are trying to understand how an acquisition scorecard would, or how what would be the key variables for an acquisition model if you are trying to develop an acquisition model for a a credit card product, right? So that's something that we are trying that we will be trying to do. So similarly, and what we are trying to understand is how are the strategies being built. So that's broadly that we are trying to address currently, right? And from there we'll move on to the rigid inferencing section in the next session, right? So because that's more on the technical side. So once I am done with the overall understanding of scorecards and its applicability, we will deep dive into the methodological framework as well a little bit, right? So till now, and just have the idea that for reject inferencing is done to create an idea about the, or infer about the flags, infer about the bad flags in the, so to infer about the nature bad flag for the rejected base. Right?
Okay then.
Okay. So is the flow of the discussion clear to you, Suji, as well? Are you clear as well?
Yes.
Okay. So just let me first of all highlight on the key variables. Now, when we are building an acquisition model, any kind of acquisition model, not only a credit card, but we'll just focus on credit cards as a product, right? Now I'm focusing on credit cards as a product because it's a very typical revolving product that we have, right? So you have a limit on the card and you have an outstanding balance on the card. So after your, based on your usage, and there is a particular payment pattern for the class. There is a payment pattern for the class. So I have the limit on the card, I have the balance on the card, and I have the payment on the card. And as we all know that credit cards are a revolving product, right? So they are something that we need to look at, that they are something that we need to understand. So over here, like I have limit, balance and payment. So when I talk about limits, balances, limit, balance, payments and so on, right? So what I am trying to do over here is I am just trying to, so what I'm trying to do is I'm trying to assess that whether I should be giving this revolving product to a particular borrower. Now, given now to assess whether I should give this loan to a particular borrower or not, I have two set of information. One is obviously the bank's internal information. The bank's internal information. Right? So bank's internal information, and the second is the external or the bureau information. The external or bureau information. Now these two are the most important set of, so, broad variables, right? Now even in today's world you have a third set of wing, which is alternative information as well. So there is a very important concept of an alternative credit scoring in today's world, right? So alternative information set. So what we have over here is the alternative set of information. So what the way we are gradually seeing this is as follows. So for the bank's internal information, there is an external. So one set of information is bank's internal information, external or bureau information, alternative set of informations. Right now, if I club these two information set together, right? If I club these two set of informations together, then what I'll get over here is that these both are external information, and an acquisition scorecard model is dominated by the external information base. The external information base, right? So both of them are actually taken care of by, or they are kind of captured by external information base, by external information sources. On the other hand, what we have is the bank's internal information. Now bank's internal information is only would be relevant if the applicant is an existing customer of the bank. For the existing customer of the bank. of the banks. So this will be relevant. Now on the other hand, so this is not applicable. So it would be not applicable for new to bank customers. So in any possible way, in any possible way, the relevant existing customer of banks have been or are the ones who can use relevant info the bank's internal information for the external sources, external bureau information. What we have over here is we have the so basically the external set of information, which is the third party information, which gives an idea about the historical behavior of the borrower in a general framework, right? Or generally gives the historical behavior of the borrower is the external information, and hence external set of information would always dominate the the acquisition scorecards, or would be the dominant set of variables. The dominant set of variables. Now, when I say they are going to be a dominant set of variables, what I imply over here is the following. Number one, so over here we'll first explore these kind of variables, right? Okay, so key risk drivers. Now, if I am giving a credit card to a borrower, right, or to a new borrower, so who has never been on the books of my bank, right? So what is the key? What are the first set of risk driver that I would like to look at? The first thing that I would want to look at is that how has this particular borrower behaved in similar products? How has his behavior been in terms of the similar credit products, right? So that's the first thing that I would try to address, that how exactly is it that you have been, or how exactly have you kind of worked with this, how have you worked as so what are the factor that you would look at if you were to give it a credit card? And the first thing would be lending on a behavior on similar products, or historical behavior on similar products. On similar products. Historical behavior on similar products. Now, if I'm talking about the historical behavior on similar products, then what are we doing over here? Then what we are doing is we are trying to understand how exactly is it that this borrower will behave in terms of two kinds of products. One of the most important set of products that I'm looking over here is current accounts. And the second set of accounts that I have, or the second set of product that I would look into is other credit card behavior. Other bank credit cards. So other bank credit cards, right? Now when there is an other bank credit card, and the third set of similar product that I would look into is the revolving products. Other revolving products. Excuse me. So others. Now bureau data in so all these come from the bureau data, right? So first set of information, the current account information comes from the current account block. So bureau data, like an Experian data would have, or Xtrify data would always have a current account block. Current account. So this comes from the current account block information under in the from the bureaus. Now when I say current account block, so current account blocks contain any possible information on the behavior of current accounts, right? So what it contains is, so number of current accounts that you would have historically, on the number of current accounts where you have outstanding balances, number of current accounts that the borrower has gone delinquent into, the total amount of delinquency balance into current accounts, then the delinquent number of current accounts which are 30 days past or more, and things like that, right? So there are multiple, so there are different kinds of variables that we tend to look at, right? Now this part comes from the revolving product block. So there is a block which focuses only on revolving products, not not current account. Current accounts you have a separate block in the bureau known as the current account block. Now revolving product blocks are the second block of information that the borrower the lender must look at. Now this others portion can come from the bureau, so can be a bureau piece of information, or this could be other fintech or other sources. The other sources. So that is, so other sources hint at the alternate sources. So let me explain this part. So this can be extracted from either from the bureau or from the alternate sources. Okay, so let us try to see how this particular portion actually works, or what are the key kind of variables that we come across, right? So just let me start by listing down the number of for the current account blocks. You have variables in the current account block. Hmm. Number one is total number of active current account. Right. So the first thing is total number of active current account held by the borrower as on a given date. So basically, when you are extracting the data, right? So as on that month or as on a certain given reporting date, the total number of active current accounts that are held by the borrower is something that we must look at, right? So the total balance in the active current account across the active current accounts is another important variable in the current account block. Current accounts of a borrower. Okay. Guys, just give me a minute. I'll just be back.
This conference will now be recorded.
Okay. So thank you guys. Thank you for waiting. So let's connect. Let's continue. So basically we were talking about the variables in the current account block, right? So these variables that I am talking about over here, right, is based on the Experian bureau, right? Now the blocks can vary, the name of the blocks can vary from the bureau to bureau, or the exact name of the variables can vary. However, the same block of the variables will be available there, right? So that would not be a problem. I mean, the nature of the variable would remain similar. And in fact, these can also be used for developing different kind of strategies at the acquisition or at the behavior level, depending on the level at which you're building the strategies. So over here, on one side, we have the total number of the active current accounts held by the borrower as on a given date. The next is the total balance across the active current account of a given borrower. The next thing that we have over here is total balance in delinquency across the active current accounts of a given borrower. Right? So the next point over here is the total balance or proportion of the balance in default, the current accounts of a given borrower. Right? So now when I talk about the total number of active current accounts held, or total balance, so over here it could be the total balance or could be the proportion of the balance. So it could be a total or a proportion of the balance given borrower. What? Okay,
Tanmay,
yeah, tell me.
just want to ask the points in 3 and 4. I mean, in current account, how can the delinquency be tracked? I mean, delinquencies for will be for a product, right? Like credit cards or
No,
personal
for current
loans.
account you can also track it. So if you have an overdraft facility, so current account with
Okay,
overdrafts, right? So
okay,
basically, let's say you have 2,000 rupees in your account, but you have drawn 3,000 rupees, and your over limit is, let's say, 5,000 rupees. So you can draw, the total drawing you can do is up to 7,000 rupees, because the balance plus the limit. Now you have drawn 3,000 rupees, right, today. Now the idea over here is that within 7 days that money has to be given back, or the time frame is very small. Now if you don't pay within that time, then your delinquency count begins.
okay. So it is current account with OD facility, right?
Correct, correct. So
Thank
mostly
you.
when we in Europe, when we talk about current accounts, they come with an overdraft facility,
Okay. Thanks. Thanks.
because the data that I'm talking about is an Experian data, right? Guys, just give me a second.
This conference will now be recorded.
Sorry, I missed you. Okay. Fair enough. So, as I was saying, right? So basically, when I'm referring to a block of to the current account block, so these are different kinds of variables which are there, right? Now you have the total proportion of the balance in default across current accounts of a given borrower. Now the question over here is that why is this current account behavior so important for modeling acquisition behavior in you know for modeling the acquisition behavior of credit cards. So why do you think credit like current account behavior is so important to model the credit card information, or the credit card acquisition risk? What does current account have? Now how do I guide, or what guides my decision to give a card to a borrower who has a current account vis-a-vis who doesn't have a current account? Now think about it this way. Credit cards have very high rates of interest, right? And they are revolving products. And secondly, they are unsecured products, right? So for credit cards, there are two things that we have over here. One is that credit cards are revolving products and they are unsecured products, right? As a result, the rate of interest on credit cards, the interest rate or the rate of interest on credit cards is very high. The rate of interest is very high, right? Now if the rate of interest is very high, what happens over here, right? So when the rate of interest is for a product is very high, right, the exposure or the billing balance gradually increases, and it increases to a large extent, and hence chances of defaults increase because credit cards are unsecured products. However, there is another source of risk that can arise. Think about it like this, that there is a borrower who has a current account with an overdraft facility, right? So when I'm talking about current account, I am basically talking about overdraft products with kind of with overdraft facilities and authorized overdraft. I'm not talking about unauthorized overdrafts or things like that. So over here, if the borrower has a current account, access to a current account, what can happen is that, let's say he has a overdraft limit of 3 lakhs, right, and his credit card limit is 1 lakh or 1.5 lakh. Now what he can do is he can actually use this current account to pull the money and pay the entire card bill on the card bill, and then he may default on the current account balance. Now the problem with current account is that the exposures for current account is relatively higher because the limits, relatively high limits are given to current account than credit cards, right? So so in terms of interest rates, or in terms of in terms of interest cost, current accounts are even more riskier, right? So over here, when we are kind of trying to build this acquisition scorecards, or these kind of scorecards, right? Then then it is imperative that we have these current account informations considered. Because if I have these current account information considered, then I know that I can actually risk distinguish between the borrowers. So borrowers who have a current account is relatively more riskier, or would turn out to be relatively more riskier than the borrowers who do not have a current account. So if I have a current account variable in my model, I can easily risk distinguish, because current account provides an additional challenge, additional channel for a borrower to repay the credit card loan and arbitrage that loan in a manner so that he repays it using the current account, and then he defaults on the current account where the exposure of the bank is much higher, right? So that is why the current account behavior, or his trend on current account behaviors, should be very adequately judged. Now, this is the first reason, right? So, ideally, I would want to give a credit card to a borrower who does not hold a current account, because I know that the borrower would be relatively safer over there. On the other hand, when I'm talking about the total number of active current accounts held by the borrowers, right? So when I'm doing this, so one part of this portion will work like this: that that if I do not know how this borrower is going to behave on his credit card, I can actually look into how he has behaved on another alternate revolving product, which is the current account. Now, if his behavior on current account has been very consistent, such that he has many current accounts, the proportion of the current accounts, so I look into the distribution of the balance across the current accounts, right? What proportion of balance is he holding, or I look into the total sum of the balance that he is holding, or I look into the average balance that he is holding in each of the current account balances, in each of his current account, and out of that, what proportion of that balance is into delinquency on a card wise basis and on an overall basis. I will be able to infer how consistent is this borrower as a or borrower profile is in terms of using a revolving product like a current account and then repaying it back on time. So if someone can manage their current accounts easily, then they would be easily able to maintain their credit cards as well. So while on one hand current account gives me an idea of a source of risk, origination source of risk of the borrower, it also gives me an idea about whether the borrower should be given the loan or not. So basically, if I am looking towards a segment where borrowers have current account, there the different patterns of current account behavior will work as risk distinguishing factors. Segments with no current account will not have these variables. It will have other set of variables. So on one hand, while current account information helps me build my acquisition model segments, it also helps me build or choose the adequate type of variables to assess the riskiness of a borrower who has a current account, right? So so it gives me, so while on one hand it works as a the segmentation criteria, it also works as a reliability factor of the borrower, because the patterns of payments that this borrower has, right? So it would give us an idea about, or his on his delinquency patterns from the current account block will give us a clear cut idea about how has he been as a borrower on current accounts, which is a very similar product to credit card in terms of its nature. Hence, the current account information is a very critical information for for acquisition models like retail, like credit cards, or for that matter, even personal loans. Right? Current account information or historical current account information helps you risk distinguish the borrower right at the source, right at the body. It helps you distinguish these borrowers, and this is a very robust source of information, because it is not impacted by any of bank's management decisions. It solely reflects the historical behavioral aspects of a borrower, which at origination for a bank is very important, right? So that's how this variable block would be one of the most important variable blocks. Clear? Any questions up to this point? Is this part clear to us? Are we clear on this?
Yes.
Right? Okay. So this variable, this current account block variable, as we were talking about it, so this will give us, so this is a clear source of assessing the reliability of the borrower. Oh, excuse me. The reliability of the borrower basis his historical behavior on credit. Right? Now let's look into other credit products. Now other bank credit cards. So basically, while current account block is a separate source, so there is another independent source of information which talks about the behavior of the borrower on on other credit cards. Now let's say that I have a borrower. I can have, what are the possible combinations of borrower that I can have? One is I can have a borrower who has a historical current account as well as he has a credit card. Number two, there is a borrower who has a current account but not a credit card. There is a borrower who has a credit card but not a current account. Borrowers who do not have both, right? So therefore, to capture the second set of informations, now if a borrower is not having a current account, right, then the next fallback is to assess his information on other credit cards. How is he kind of behaving on other credit cards, or the historical credit card that he has taken from the bank, right? So that's the second block of information that we would have over here. The revolving credit block. Number one, again, so over here the set of the variables will be very similar. So the total number of credit cards except the bank in question. So how much of credit does this borrower hold, or credit card does this borrower hold, apart from the bank in question? So how do you get it? The total number of credit cards held by the bank minus 1. Now, now basically, let's say if this borrower is actually applying for a credit card, then this borrower doesn't have a credit card of this bank. So total number of credit card in the bureau system will be a testament to the fact that the total number of uh, credit card that he has from other banks, right? Now also at acquisition, if you look at these variables, the total number of current account held by the borrower and the total balance held by the uh, you know the total balance, that is their total active balance, is always not a negative measure of risk. It can also speak about the, it can also speak about the, what do I say? It can also speak about the affordability of this borrower, that he has been a very good borrower. right? So that is why multiple banks have given him current accounts, or he has multiple current accounts given to like that he has or that he uses, and he has substantial balances across these. So therefore, if you look into the first two set of variables, the first two set of variables get can be positively associated with the borrower's score, right? So basically, higher these counts are, lower can be the risk, showing that the borrower's the borrower's ability of or credit worthiness is a good credit worthiness, right? Now, on the other hand, what can also happen is that, so if you move to the next set of variables where you are looking into the average balance distributions, and where you are looking into the the total count of the you are looking into the total count of the products, and you are looking at the total amount of balances over there. So while that gives you an idea about the borrower's affordability or credit worthiness, the delinquency distribution across these cards can give you the idea of the riskiness associated with the borrowers, right? So higher the risk distributions are, higher the delinquency buckets are, or higher the proportion of the balances in the delinquency buckets are, the more riskier the borrower will be. So both these group of factors are punched across. So both these two group of factors are punched across in these blocks of variables, right? So similarly, when we are looking into the credit card behavior, the historical credit card behavior, similar reflections can happen, right? So do not always consider that all of these factors will be positively associated with the riskiness of the borrower. Some can penalize the riskiness of the borrower, while some can reduce the riskiness of the borrowers, right? So it's a mix of the two. So we need to judge that which variable is the one that we should be looking at, and that's where the role of an actual versus expected analysis actually comes in, which we'll discuss when we go into scorecard development, right? So that is uh, so that's how these variables would be looked at, right? The next thing that we have over here is the variables in the revolving credit product blocks. So similarly over here, when we're looking total number of credit cards or the total balance across all the credit cards. Now this is total. When I look into the total, it could be the average balance as well, average balance across all the credit cards, or average balance distribution across all the credit cards. Now there can be another factor, which is the average balance as a proportion of the total limit assigned. Or let's say I'll put this at average utilization across the cards. Now, when they talk about average utilization across cards, right, the bureau creates more variables. Like say average utilization across cards, which is less than 30% of the utilization. Average utilization across cards between 30 to 50%, more than 50%, and so on. So average. So on the other, we have the average utilization across the cards, right? So when you're looking into these things, so basically, let's say based on the average utilization, there are other different cutoffs which are created, right? So So that's how these average utilization variables are created, right? So now with average utilization, you can create bands of average utilization and you can have a look into them. And then you can see which is the better variable, which is giving you which is giving you a better idea, right? Then there are average payment variables, payment balance ratio variables for historical lending, for historical usage of the cards, right? So there are multiple variables which are available. But just have a look into the type of the variables that we are that we are kind of listing. So if you have a look into the first three set of variables, you will be able to assess the credit worthiness of the borrower, the tendency of the borrower to utilize the credit, and what you will be able to see that how many banks have historically given the card to the borrower, showing that he has been a good borrower, right? However, as I go on with the so number of cards delinquent in the first cycle, average balance in delinquency across the cards, or in 30 days, or in first cycle delinquency. So that is 1 to 30 days past due delinquency across the cards. So this is so things like these are kind of important, right? So when I look into the average balance into the delinquency distribution, so proportion of balance or number of cards in default, total balance or average balance in default for a customer out of the total cards. Right, so there are these kind of variables. So any delinquency related variable on the historical behavior, any payment related information which reflects inconsistency in the payment of the borrowers is something which should not, or is something, which should be taken as a risk factor. Else it should be taken, or either otherwise you can take it as a measure of certain credit worthiness of the borrowers, right? So that's how this entire thing would work. So is this part clear to us? Are we clear on this? On the kind of key risk drivers that drives. Now, if you look into both of these two factors, they'll give you an idea about the creditworthiness of the borrowers and about the reliability of the borrower in terms of the repayments, right? So, bureau variables play a very critical role. Now, even if the borrower has not taken a bank or is new to the bank, right, and has a credit history with the bureau, then even then you can develop the model. Even you don't need the bank's internal information here, because this bank's internal information in some way or the other would be already be reflected in the bureau. So also basically at an acquisition stage, for areas, so where you have an active bureau, it is the bureau information which actively uses these models, or actively uses variables to develop robust models of lending, right? So in tomorrow's discussion, I'll let's take a pause here for the day today. In tomorrow's discussion, what we'll talk about is we will talk about the so we will talk about how we'll talk about how exactly uh, we'll talk about the affordability factors in the bureau, other bureau blocks, and from there we'll move on to see how these variables look like in the data and how would you use them for, or how exactly a variable selection can be done to reach the final model variables and how to interpret the final model variables that we obtain, right? So that's the part that we discuss in tomorrow's session, right? So thank you guys, thank you for your time, and let's reconvene tomorrow.
Tanmay, I just want to ask one question.
Yeah.
This falls under the business segmentation, right?
Which
These are
one?
all part of business segmentation. These,
So these are not
I mean,
segmentation,
the
these are
variables
model
in the.
variables. So these are model variables. So you
But
have
we are
you
segmenting. Yeah.
you can use it for segmentation. I'm not saying that you cannot use it for segmentation. So even if you do a statistical segmentation on a car and you create a current account indicator variable, right? Then you would see
Yeah.
significant splits happening around that current account indicator variable. And we will discuss that part. We'll discuss that part
Okay.
in tomorrow's discussion. Uh,
Okay. Thank
okay,
you.
great. But Mubashir, one thing, I think your session was from 10 a.m., right? IST?
Yeah, yeah, yes, correct.
Yeah. So please join the 10 a.m. session. So that's where yours batch was starting. So I did not expect Tanuja and you to join today over here. I thought you guys would join at the 10 a.m. batch because I had
But
I'd written out the mail, right?
yeah, yeah,
Not a
but
problem.
then
I close this session. I
okay,
close this session and I'll reopen the session. So this session will get recorded and you can join the fresh session over there.
okay, great.
Okay. So, Moushumi, you please join the fresh session. So this is the I'm closing on the current session, and I'm closing on the current session, and we will reconvene for your batch in the next session. Thank you.